Okay, let's talk about KE Holdings, or as many know it, BEKE. Their latest earnings report, well, it's really a tale of two very different companies. You've got profits in their core business taking a serious nosedive, but at the exact same time, a brand new AI-powered engine is just starting to roar to life. In this deep dive, we're going to break down exactly what this massive pivot means for you, the investor.
All right, let's get right to it, because this is the core puzzle for any investor looking at BEKE today. Net income has taken a sharp dive, and yeah, that's a major red flag. But, and this is a big but, the company's new ventures have just hit profitability and they're growing at a breakneck pace, all driven by a massive strategic bet on artificial intelligence. That's the story we're here to unpack.
So here's our game plan. First, we'll slice through the Q3 financials. Then, we'll diagnose exactly why the core business is under so much pressure. After that, we'll get to the good news, the new segments that have just turned profitable. From there, we'll dig into the really fascinating part, their big AI-powered efficiency drive. And finally, we'll talk shareholder returns and what to look for going forward. Let's jump in.
Okay, first up, the financials. And let me tell you, on the surface, things might look okay, but this is a really mixed picture for investors once you look a little closer.
So, let's start with the big one, gross transaction value, or GTV. It came in at just under 737 billion RMB. What does that tell us? Well, it's basically flat compared to last year. So activity on their platform isn't falling off a cliff, but it's not really growing either. It's just holding steady.
Now, that stable GTV translated into a little bump in net revenue, up just over 2% to 23.1 billion RMB. A little growth is better than no growth, right? But I wouldn't get too comfortable, because this is pretty much where the good news on the income statement ends.
Because when we get down to the bottom line, net income, it was only 747 million RMB, and that is a major drop from the same time last year. This is really the headline number that got everyone's attention.
And this chart right here really puts it in perspective. Just look at that. Profits fell from almost 1.2 billion RMB last year all the way down to under 750 million this year. That's a 36.1% collapse year over year. A number like that tells you just how much pressure BEKE's core profitability is really under right now.
So, the big question is why? Why the huge drop in profit? Well, the answer lies squarely with what's happening in their traditional business segments. They're facing some serious headwinds.
Okay, this table tells the story pretty clearly. You've got the two main pillars of their traditional business, and both of them saw revenues go down. Existing home services down about 3.6%. Not great, but okay. But look at new home services. It plunged over 14%. That is the real source of the pain.
And what drove that big drop in new home revenue? It was this. The total value of new homes sold on their platform, that GTV, fell by almost 14%. It's simple, really. Fewer new homes were sold, and that hit the top line hard.
And you don't have to take my word for it. Let's hear directly from management. BEKE CFO Tao Xu laid it out perfectly on the earnings call. He said, recently, the prices of existing homes have been considerably more attractive, leading both first-time buyers and home upgraders to choose existing homes. So buyers are just being smart with their money, and that's shifting demand away from the new construction market.
Okay, but it is not all doom and gloom, not by a long shot. Because while that core business is struggling, this report also uncovered a huge bright spot, the incredible performance of BEKE's newer business lines. This is where the story gets really interesting.
This really is a tale of two businesses, isn't it? On one side, you have the legacy business, the existing and new home revenues, and they're declining. But on the other side, you have these new ventures like home rentals, where revenue is just growing like a weed. It perfectly shows the strategic shift that's happening inside the company right now.
I mean, just look at this number, plus 45.3%. That's the year-over-year revenue growth for their home rental services. That's not just growth, that's an explosion. This is exactly the kind of thing you look for as an investor, a powerful new engine starting to fire on all cylinders.
But here's the real kicker.
Honestly, this quote from the CFO might be the single most important piece of information in the whole report. He said, both home renovation and furnishing business and home rental services achieved city-level profitability. Now that phrase, city-level profitability, is absolutely crucial. It means these new businesses are already making money in certain cities, even before you factor in corporate costs. This is the proof investors needed, that these aren't just cash-burning experiments anymore. They're becoming real, viable, profitable businesses.
So, how is management planning to navigate this transition? How do you manage a shrinking core while growing these new ventures? Their answer is crystal clear, and it all comes down to one thing: a huge strategic bet on technology, specifically artificial intelligence.
The CEO, Stanley Peng, summed it up perfectly. He said, "We are strategically shifting our growth engine from scale to efficiency." You hear that? It's not just about getting bigger anymore, it's about getting smarter. And that's not just a minor tweak. This is a fundamental change in how they think about their entire business.
And look, this isn't just corporate speak or some buzzword they're throwing around. They're actually doing it. In that booming rental business we just talked about, AI is everywhere. It's identifying leads, it's setting prices, it's managing their staff, it's controlling risk, it's even acting as an assistant for agents during negotiations. It's being baked into everything. They call it building an AI-native operation. Think about that. From the very first step, when they're signing up a new property, AI is already there, evaluating it, setting the price, spotting risks. Then, AI takes over to drive the leasing. And the results? They're pretty incredible. Their automated AI risk review system has boosted efficiency by a staggering 64%. And to bring it all home, let's go back to the CEO, Stanley Peng. He calls this a new path to growth, one that restructures our operating model with technology and drives scale expansion through efficiency. So for them, technology isn't just a tool. It is the way they plan to restructure the company to build scalable, profitable growth long into the future. Okay, last section. Let's talk about what all this means for shareholders and how management is putting its capital to work during this big transformation.
And you know, management is really putting their money where their mouth is. Look at this number, $2.3 billion US. That's how much of their own stock they've bought back since late 2022. To put that in perspective, that's about 11.5% of all their shares before the buyback started. That is a massive vote of confidence from the people who know the company best.
And they're not slowing down. They're speeding up. Just in this past quarter, they spent $281 million on buybacks. That's the most they've spent in a single quarter in 2 years. When you see that, it tells you they are dead serious about returning value to shareholders, even while going through this huge transformation.
So, this all brings us to the ultimate question, the one every investor has to ask themselves about BK right now. Can the company's big AI pivot successfully navigate the massive cycles of China's property market? The core business is still very much tied to that market, but its future is being built on a new foundation of technology and AI-driven efficiency. Can that pivot create a more resilient, more profitable company? One strong enough to not just survive, but actually thrive through the industry's inevitable ups and downs? That is the multi-billion-dollar question.